Hello, I'm Sebastian. Welcome to 9 Trees podcast. Today, I will summarize and review the book Meltdown, Greed, Scandal, and the Collapse of Credit Suisse by Duncan Mavin examines how one of Switzerland's most storied banks unraveled after years of reputational damage, risky decision-making, and internal dysfunction. Built on widely reported events and public records, the book traces Credit Suisse's slide from a global wealth management powerhouse to a crisis case that ultimately required an emergency rescue. Mavin frames the story as more than a single failure or isolated scandal. It is a compounding breakdown where governance lapses, aggressive growth ambitions, and poor risk controls met a modern media and regulatory environment that no longer tolerated secrecy and half measures. Along the way, readers encounter the pressures of investment banking culture, the fragility of market confidence, and the speed with which liquidity can evaporate once trust is shaken. The result is a cautionary narrative about incentives, accountability, and the hidden costs of chasing revenue at any price. I will give you key takeaways from this book. Firstly, a legacy institution under modern pressure. The book situates Credit Suisse within the long arc of global banking, where legacy prestige can mask structural weakness. A key theme is the tension between the bank's traditional identity as a discreet Swiss wealth manager and its ambitions in high-risk, high-fee investment banking. Mavin highlights how the post-2008 environment intensified scrutiny, raised capital and compliance demands, and reduced tolerance for opaque practices. Yet competition for returns remained fierce, pushing large banks toward complex products, leveraged exposures, and aggressive client acquisition. In that setting, Credit Suisse faced a strategic identity problem: which businesses should define the franchise, and what risk appetite fits the brand. The narrative shows how hard it is to pivot a large financial institution when culture, compensation, and internal politics favor short-term wins. As markets evolve and public expectations change, past reputation stops functioning as a safety net. Instead, the bank's history becomes a burden if leaders rely on it as proof of resilience. The topic underscores that modern bank stability is not only about balance sheets, but also about credibility, strategic clarity, and the ability to adapt without losing control of risk. Secondly, greed, incentives, and the human drivers of risk. A central strand in the story is how incentives can quietly steer an institution toward danger, even when formal policies say otherwise. Mavin explores the human motivations that thrive inside major banks: status, compensation, lead tables, deal momentum, and the belief that sophisticated models can tame uncertainty. When revenue targets become dominant, warning signs are more easily rationalized. Relationship managers may defend lucrative clients, trading desks may push for higher limits, and leaders may reward growth narratives that look strong in quarterly results. The book also illustrates how fragmented accountability can dilute responsibility. If many teams touch a transaction, each can claim they relied on someone else's checks. Over time, repeated exceptions, workarounds, and one-off approvals can become normalized. This topic emphasizes that financial blow-ups are rarely caused only by technical miscalculations. They are frequently the product of everyday decisions made under pressure, where the organization implicitly signals that profit is valued more than caution. By focusing on the behavioral and cultural mechanics of risk-taking, the narrative helps readers understand why sophisticated institutions can still make surprisingly basic errors in judgment. Thirdly, scandals, compliance failures, and reputation erosion. Meltdown tracks how public controversies and regulatory issues can weaken a bank long before a formal crisis appears. Mavin shows that scandals are not merely embarrassing headlines, they impose tangible costs through fines, legal exposure, management distraction, and tighter oversight. More importantly, they corrode trust among clients, counterparties, and employees. Each high-profile failure makes the next allegation more believable and reduces the benefit of the doubt when leadership promises reform. The book portrays reputation as a form of capital. Once depleted, it becomes harder to attract stable deposits, win mandates, or retain top talent, which in turn harms financial performance and increases risk. Compliance is presented not as a box-ticking function, but as a frontline defense that must be empowered and integrated into decision-making. When compliance is sidelined, under-resourced, or overridden, the bank's vulnerability grows. This topic also highlights how modern information flows accelerate consequences. In a world of rapid news cycles and social media amplification, scandals can quickly shift market perceptions and trigger internal panic. The cumulative effect is a slow-motion weakening that sets the stage for a sudden collapse. Fourthly, governance breakdowns and leadership missteps. Another major topic is governance: how boards and executives monitor risk, enforce accountability, and set coherent strategy. Mavin's narrative emphasizes that repeated crises often signal not bad luck, but weak oversight and inconsistent leadership. When strategic priorities change frequently or are communicated poorly, Business units may pursue conflicting goals, and risk teams may struggle to set firm boundaries. Leadership churn can deepen the problem, as incoming executives may launch new restructuring plans before prior fixes take hold. The book highlights the challenge of running a bank with multiple power centers, where internal rivalries and legacy fiefdoms complicate reform. Governance also includes the quality of information leaders receive. If reporting is sanitized, delayed, or overly technical, decision-makers may not grasp the true exposure until it is too late. This section underscores that a strong governance system requires more than formal committees. It needs a culture where escalation is rewarded, dissent is heard, and incentives align with long-term stability. Without that, even talented leaders can end up reacting to events rather than shaping them, allowing small problems to compound into an existential threat. Lastly, from confidence shock to emergency rescue, the book culminates in the mechanics of a modern banking failure, where confidence can evaporate faster than fundamentals change. Mavin explains how a series of damaging events can trigger a tipping point. Clients withdraw assets, counterparties tighten terms, funding costs rise, and rumors accelerate outflows. In banking, liquidity and trust are intertwined, so once stakeholders suspect weakness, defensive behavior can create the very crisis they fear. This topic explores why emergency measures often come late. Leaders may hope markets stabilize, regulators may prefer private solutions, and public statements may aim to calm rather than fully disclose. Yet in a fast-moving crisis, partial reassurance can backfire if it appears evasive. The narrative also shows how system-wide considerations shape outcomes. Authorities weigh contagion risk, cross-border implications, and the credibility of the financial center itself. The rescue becomes not just a corporate event, but a political and regulatory decision under extreme time pressure. By walking through the collapse dynamics, the book helps readers understand why a large institution can fall quickly, and why the endgame is often determined by confidence, coordination, and timing as much as by accounting metrics. In conclusion, this book suits readers who want to understand how large financial institutions fail in real life, investors, finance professionals, regulators, business leaders, journalists, and curious general readers following the aftershocks of the banking sector's recent turmoil. It is also valuable for anyone interested in organizational behavior because the story illustrates how culture and incentives can overpower formal rules. The main benefit is clarity. The collapse is not presented as a single shocking event, but as an accumulation of choices and missed signals that gradually made the bank fragile. That perspective helps readers evaluate other institutions more skeptically, ask better questions about governance and risk, and recognize how reputational damage can become a balance sheet problem. Compared with broader books on the 2008 crisis, Meltdown is worth buying because it focuses on a modern, widely watched failure that unfolded in a different regulatory era, with faster information flows and tighter market tolerance for repeated missteps. Rather than treating banking as abstract, it connects strategy, scandal, and confidence into one coherent cautionary case study with practical lessons about accountability and resilience. If you would like to support Duncan Mavin, you can buy the book through the Amazon link I've provided in the podcast description. After reading the book, please let me know what you think and share your thoughts. See you around.